So it finally happened. We just saw the first rate hike from the Fed since 2018. And this is going to affect every sector of lending, from your credit card interest rate, your student loan interest rate, vehicle interest rates, and of course, your mortgage interest rate. And if you've been watching the mortgage rates over the past couple of months, you'll know that they've been steadily climbing. And the Fed increasing the federal funds rate isn't helping. So let's talk about what we can expect in 2022 for mortgage rates and what that means for someone like you who may be thinking about buying a home in 2022. Now, if you're not aware, the federal fund rate is an interest rate between banks. Banks have to meet certain cash reserve requirements every single day, and if by the end of the day they don't have enough cash on hand, then they can lend some cash from other banks. And if a bank has a surplus of cash, then they can be the lender lending that out to other banks so they can meet their cash reserves. And the interest rate that these banks pay each other in interest is the federal fund rate, or the Fed rate. And when the federal fund rate goes up and banks have to pay more money in interest to meet these cash on hand requirements, of course they're not going to let you get off without paying extra interest, and they'll be charging their customers higher interest rates as well on their vehicle loans, on their mortgages, or on their student loans, or anything else. And ever since 2020, when the federal fund rate was reduced down to zero, lending and borrowing money has been extremely cheap. That's why we saw mortgage rates go below 3%. The Fed was looking to boost the economy, so they decreased the rate to incentivize lending and spending. But since then, the economy is doing pretty well and inflation is at 40-year highs. So in order to combat inflation, one of the tools that the Fed has at their disposal is increasing the federal fund rate. Because by decreasing that rate, you're going to be less incentivized to go borrow and less incentivized to go spend, and so this may help to decrease the rate of inflation, which is what the Fed is looking for. And the Fed just announced that they're increasing the federal fund rate by 25 basis points, and we can expect about 6 rate hikes or so this year. Now, what does all of this mean for mortgage rates and home prices? Well, since the cost of borrowing money is increasing and we're expecting more rate hikes throughout the rest of the year, if you're looking to buy a home in 2022, if I was in your position, I would go lock in a rate right now and get a home as soon as possible, because you are running the risk by waiting of getting a higher interest rate and having to pay more money over the length of your loan to the bank, which nobody wants to do. And with every 1% that your mortgage rate goes up, your purchasing power actually decreases by 11%. That means that with an interest rate of 4.5%, if you could afford a $400,000 home, but then the interest rate goes up to 5.5%, now you can only afford a home that's about $360,000. And whenever people talk about rising interest rates, they often talk about how that's going to put some negative pressure on home prices, and maybe we could see some home prices cool down. And while that can happen in some cases, it's not guaranteed, because mortgage rates and interest rates are not inversely correlated, meaning that just because one of them goes up, that does not mean that the other is going to go down. In fact, we could see a situation like we've seen in the past where we have high interest rates as well as high home prices. Basically, you get hit from both sides. And when you combine both of those, you have high home prices, which we already have across the country, and you see that mortgage rates starting to creep up higher and higher and higher. You get this situation where it becomes very difficult for the average American to afford a home. Here's an example. In 2008, home prices dropped dramatically. We all know that. But also mortgage rates took a steep decline during that time. And then in 2020, when the Fed dropped their rate to zero, we saw mortgage rates hit record lows. But at the same time, we also saw home prices skyrocketing. We can look through history and see multiple occasions where home prices and mortgage rates sometimes have a direct correlation and sometimes have an inverse correlation. Even if mortgage rates creep into the 5%, 6%, or 7% range, there's still a lot of other factors that are keeping home prices high, such as the 5 million homes that were short across America. So what does this mean for you, someone looking to buy a home in 2022? Well, if you want to buy a home in 2022, I don't recommend waiting. We don't know what the future holds in terms of the mortgage rates, and I don't have a crystal ball, so I can't tell you the future. But we do know that the Fed is planning on more rate hikes throughout the rest of the year, which means that lending across all fronts is going to get more expensive, including your mortgage rate. And remember that time in the market beats timing the market. Very rarely in real estate, stocks, or crypto do people time perfectly the top of the market and the bottom of the market. It just doesn't happen, and if it does, it's really just because you got lucky. If you're putting off buying a home right now because you think you could get a better deal in the future by waiting, you're most likely just missing out on appreciation and a cheaper loan, because there are plenty of people that said at the start of 2021 that they wanted to wait for the housing market to cool off. But now, depending on the market that you're in, home prices have increased by 30% since January of 2021, and interest rates are almost double. And obviously, home prices aren't just guaranteed to keep going up, and interest rates also aren't guaranteed to just keep going up. But if you're looking to buy a home that you're going to live in for the next 5 years plus, even if you overpay for a home right now, as long as you're in the home long enough, even with a crazy recession in the housing market, you'll still come out on top. If you are trying to buy a home and flip it within a year or two, then that's going to get a lot more unpredictable. But again, time in the market beats timing the market. So let me know what thoughts you have down below. Thanks for watching. Remember to subscribe, and I'll see you in the next video.